Welcome everyone. My name is Brian Gregory and I'm the president of Aldridge. So for those of you that don't know us, we are an MSP based in Houston, Texas. We've got offices now in San Antonio, which we're here to talk about today. Also a new office in Fort Worth and previous offices that we have in Dallas, Austin, and Seattle, Washington. And so welcome everyone. Happy to have you here today. Just a couple of housekeeping items. After the webinar, you guys will receive a short survey. Please give us that feedback. Let us know what topics you're looking forward to in the future. We're happy to continue this series. We've had great attendance on the last few that we've done and plan to do many more in the future. So we want to make sure that we're doing topics and segments that are relevant to what you're looking for. With that, want to just do some quick introductions of folks. So first and foremost, Rick Murphy with Cogent. Rick, you want to do a quick intro?
Thanks, Brian. Hello, everyone. I'm Rick Murphy, CEO of Cogent Growth Partners. We're a mergers and acquisitions advisory company. We're specialized exclusively in the IT services space. We've been doing that for the last 11 and a half years.
Very good. Patrick, our CEO at Aldridge, any welcoming words?
Just glad to have you. I think Brian covered the who we are and what we do, so looking forward to this discussion.
Very good. And our special guest, Chad Klein with Tarrant Technology Partners and Mitch Sowards with ENTRUST Technology. Chad, you want to just give a little intro of yourself and talk about Tarrant for a bit?
Sure, I'd be glad to. Delighted to be on with everyone and to have everyone join us today. Chad Klein, I'm one of the co-founders of Tarrant Technology, which was founded in the year 2000. We grew over that 21-year period, and I guess around 2008 really began to focus in becoming a managed services provider and shifting our services revenue to contracts and agreements. And so then gained a lot of momentum and speed with the help of our participation in an evolved peer group. And anyway, we came to a transition point, and which I'll get into a little bit later, but it's been a great ride.
Great. Mitch, how about you?
So Mitch Sowards and I founded the predecessor to ENTRUST out of a spare bedroom in my house in 1991, and grew that business steadily over many years. Some mergers, name changes, acquisitions where we were on the buying side. And in the year 2006 was when the brand name ENTRUST was started. We were an early adopter of the managed services model, got our first managed services contract in April of 2003, although we all know it was really just some monitoring to which we reacted back in those days. And so you'll hear more from me later about how we ended up in being on the seller side instead of the buyer side.
Very good. Well, we're excited to announce that we've acquired both ENTRUST and Tarrant a few months ago, and we're right in the middle of integration. So we wanted to use today to talk about the path that led us to the acquisitions and a quick update on how integration's going. Through this, we'll have some pre-planned questions here that will kick off the conversation, but really want to take questions from you, the audience. So please enter those questions at any time. I'll work those into the conversation. So please don't wait till the end. Patrick, let me just kind of start with you. Why don't you just at a high level talk about Aldridge's acquisition strategy, and then ultimately what led you to realize that ENTRUST and Tarrant were a good fit to that?
Yeah, sure. So we have acquisition strategy plays a part. It's a part of our growth strategy. And so what we are doing is we're sort of on a steady march to reach about a $25 million a year revenue company by the time we get to 2023. And so there are two ways I think most of us in the technology service provider world know there are really two ways to grow. One's organic and the other is acquisition. And so we focused, so we've grown a lot both ways, right? So we predominantly focus on acquisition, doing about 11 or 12 deals leading up to about 5 years ago. And then, so we were adding nice and consistent in big chunks, with those acquisitions. And then we decided, though, that we did not have enough focus on our organic growth strategy. So then we took a few years off, 3.5, 4 years off of doing acquisitions to really focus on marketing and sales, because what we found is that our organic growth wasn't keeping up with normal levels of attrition, and that we wanted to do that plus at least 5 to 10%. And so we focused on that for several years, and then once we sort of got in a groove and had that happening, we turned back to acquisition. And there are a couple of things that drive us toward acquisition as the sort of the cornerstone of our growth strategy, and not the least of which is just time savings. So if you think about, organic growth is great, and there's nothing better than selling a new client and bringing them into the mix and really being able to help them. But it takes a lot of accounts when you're serving, small, mid-sized businesses. It takes a lot of new clients to really move the needle from a growth perspective. And so, and the shareholders of this business are, interested in, sort of, accelerated growth paths. So one of the best ways to jumpstart that acquisition. And so that's a fundamental reason. There's the next fundamental reason is breaking through sort of those ceilings that you hit. I can tell you that the first one's at 2 million and then 5 million. It's when the business really starts to change, and that you're no longer a single operator focusing on everything and knowing everything that's going on, and you have to add a layer of management, and then the next layer, another layer of management. And it's hard to manage through trying to grow and deliver great service and manage through those sort of ceilings or milestones. And so one nice thing, albeit it's a lot of work, a lot of stress all at once, but it affords us the ability to get through some of those ceilings without having to go through some of the growing pains. A whole another set of pains that we do go through, but that's generally quicker. And probably the third thing that drives us toward acquisition as a key growth driver is getting talented staff. So I think that most of us can agree that hiring good, talented technical staff is, extremely difficult. There's a little break during the pandemic where it got a little bit easier, but the few years leading up toward, and certainly in Texas, we're seeing that back in action, near full employment level for technical folks. So finding folks that are loyal and that have been with an organization for a long time. So it's as much a recruiting effort as it is anything else.
So what about geography? What about Tarrant and ENTRUST made this was the right fit?
Yeah. So from a what are we looking for point of view is really what it comes down to. And we're looking, generally speaking, for a managed service provider, so mostly monthly recurring revenue that's somewhere between 2 million and 5 million. Happens to be convenient because that's the bulk of what our industry is made up of. And then we're currently looking inside our existing markets or cities that we operate in, or very close ones to home. And so that's really what drove. So if you talk about geography specifically, the adding the Tarrant Tech acquisition in Fort Worth, we've got a significant presence in the Metroplex. We've got an office in Irving, and we serve that side of the Metroplex well. But had a handful full of clients in the Fort Worth area, but really wanted to increase our foothold there, get more involved in that community. So it was a really good opportunity from a geography point of view, and size-wise, it worked out pretty well. And then San Antonio was kind of the missing link in our covering most of the major economic hubs in Texas. And so adding the ENTRUST folks and their client base, gave us the ability to, increase our significant presence there. So from a geography point of view, which I think is what you asked about, those are just really good, solid fits from that perspective.
Very good. Well, we'll come back to what the future is going to look like, but before we do that, I want to cut to Chad and Mitch. Chad, I'll start with you. So Patrick talked about his strategy or our strategy as a buyer, but as a seller, what was your strategy? What did that process look like for you to decide to sell and when to sell and all the above?
Sure. I have to go back to 2019. I think in the early part of 2019, Alan Alpar, the other co-founder of the firm, and myself, and we also have two minority partners, had two minority partners. We wanted to kind of, what does, we had been rocking along there for quite a while, and wanted to look at what a transition plan might look like. What are our options? And I began to kind of plug into the M&A groups, things at IT Nation, things related that I was learning through Evolve. And I kind of set an informal, it wasn't a hard fast time frame, but I kind of wanted to know what I was going to do, whether I had implemented it or not by the end of 2020. It's kind of interesting enough, right about the time we kind of made that decision and started kind of educating ourselves around the M&A and the specific activity that was going on. Cogent reached out to me. I'd been acquainted with them in years past, but just kind of serendipity, it was that they contacted us in early 2019. And then we kind of started a conversation with Aldridge at that time. So that was 2 years ago now. And Patrick came to our office in August of 2019. We met Patrick. We had a good rapport there. We began down the road, but for a number of reasons, we turned down their offers in late 2019. A couple offers at that time. In many respects, we didn't hear the right things at that time for us. And we also figured out that we weren't quite ready yet. We hadn't fully defined, what did we want to get out of this deal, and more than just the money. And so we kind of took a step back. We began to look at that. Alan and I sat down with the other partners, and we kind of, defined, okay, so this is the kind of range we want in a financial transaction, but what else do we want? And it became really clear there were really three things: the financial part, what would be the experience of our employees, and how is it going to work for them? We wanted to have them have a good opportunity in front of them, and probably most importantly, how are our customers going to be treated? We'd spent 20 years, building relationships. Alan and I are very plugged into the Fort Worth community. We're not going anywhere. We needed this to be a good fit for our customers. And so we kind of, as we kind of progressed down the road, then COVID hit. I wasn't sure any M&A was going to happen. And then it started, about June of last year, things started happening again. We got into a couple different conversations. So happened Patrick reached out to us again. We kind of started our discussions, and this time I think, we were at a different place, and Patrick had learned some things from a recent acquisition, was at a different place. And so it just seemed to jive a little bit more. And we finally got to the point where we were sure that this was a good opportunity, not only from a financial, in all three areas for us. And that's been confirmed since the day I signed the LOI.
You mentioned a few things there, but one of which, having multiple owners involved. How did that complicate the decision? Did it complicate the decision? And how'd you navigate that?
Well, there two of us have a majority opinion, and so that helped a little bit in having that. But I would say every day were we all on the same page? No, but we would sit down and kind of go through, what are the options? Where are we going? How do we want to address these thoughts and needs that we each were bringing to the table? And in the end, we found the common ground in those three areas. And I think that it was also helpful through the process to where we were able to kind of have things work for each partner individually. And because we're all in a little bit different situation. And so Aldridge was helpful in that, and working with each of us individually, in addition to the whole deal.
You also mentioned having a good place for your employees was important for you. What gave you that confidence? What did you hear that made you realize that Aldridge would be that good home?
Well, I think, they wanted the whole technical team, and they were anxious about that, and to have the whole technical team, and they were interested in hearing about the team and what, the skill sets and the accomplishments of the group, and so I was, I think that was what I needed to hear. It's been even further confirmed with the way in which they're integrating and actually taking some of our management team and making it part of the broader Aldridge team. And so it's been an exciting transition for us in that regard, and for all of our people. I think they quickly, as they learned about this transaction back in March, and we began to move forward, they quickly understood that they had greater opportunity for themselves in their career, and I think it's been a very win-win all the way around.
Good. Mitch, how about you? What was your strategy leading up to selling the business?
So it is similar to Chad's. We also have minority owners. My wife and I have been the majority owners ever since the beginning. But our situation is a little bit different, and it goes like this: is that my wife and I were not ready or planning to retire, but at age 60, we knew it was going to be time to figure out what the future of this company was going to be, and we don't have children, so there was no plan or opportunity to kind of make it a generational company in that sense. My younger partners were not ready, maybe financially or even technically, right, with the range of skills to take over the company. And so back in 2019, we retained a firm to help us, look in the market and see what we could find. And we actually had a set of criteria, maybe a little more precisely than Chad did. We're looking for this, we're looking for this, we're looking for this, we're looking for this, right? And in particular, we were looking for maybe, the right kind of partner to come in and take my place, right? Take the CFO or the CEO seat, and then also do additional things, right? We wanted some greater opportunities for our clients. We wanted greater opportunities for our employees. So we had this list of criteria, and we spent 2 years, I like to say, kissing a lot of frogs, right? Our agent found us lots and lots of folks to talk to, right? But we had that strict set of criteria, and so a lot of them didn't work out, and sometimes we didn't meet their criteria either, right? Too big, too small, whatever, already in the market, not in the right market, right? So it was necessary to go through all of that. And in fact, we were kind of getting to the end of our search, I would say, and thinking about plan B and plan C. Okay, well, we didn't find any good partners. We didn't find anyone that was going to work out for us. We'll do something different. And then by happenstance at the end, and I don't really know how this happened, our agent hooked up with Rick or his firm, and said, "Hey, there might be an opportunity here," right? And then it took off from there.
What was
Serendipity.
Yeah. What was the experience working with a seller's agent? That was something different on the ENTRUST side than there was on the Tarrant side. So from your perspective, what value did they bring to the process, and maybe what challenges did you hit that you didn't expect?
All right. So firstly, I'm going to say, when you're working with an agent that's been doing this for a long time, and our agent had been also, even longer than Rick's firm, I believe, they know a lot of people. They already have big lists of people they've worked with in the past, and they have contacts all over the industry. So they were able to find a lot of frogs, right? So that's the first benefit, right? You don't have to do all the searching yourself, and you don't have to say, well, I talked to 2 or 3 people, right? And make a choice. You have lots and lots of opportunities to consider. So that was the first thing. And then the second thing is we had limited experience in mergers and acquisition. We had some, like I said, we'd done some ourselves. Having somebody who had years and years of experience allows you to ask sensible questions and say, these people are presenting this way, but I have an uncomfortable feeling, right? and they can tell you, yeah, I'd be worried about that too, or no, don't worry about that, right? You know, they can give you a sense of what's reasonable, what's not reasonable, and so forth. When it comes right down to kind of negotiating, I think there is an advantage that, remember, if a deal goes through, you know, you are going to have to live with your new partner, right? And if negotiations get contentious, it can spoil that relationship, right? So if your agents can kind of do some of that hard negotiating, let them get the skinned knees and the bruised elbows, you know, let them go through all of that so that it doesn't spoil your future relationship, right? Now, I won't say there aren't some downsides. There are some downsides to you know, kind of doing everything through intermediaries. But by and large, I think it's really helpful to have two knowledgeable, skilled, experienced agents working with each other to try and get to a good deal.
Rick, what's your experience there as far as working with a seller's agent? Do you have a preference? Do you pros, cons?
There's pros and cons, obviously, and you know, I think he touched on that a little bit. We happen to know his agent for a long time, actually, and so it was a really easy introduction. You know, they had talked to a number of different frogs, and you know, there's not always a good fit. And you know, having criteria, you know, tight criteria. And I think Patrick didn't even speak to that previously before they sort of went on hiatus. Is they also had a tight criteria, and one of the reasons they needed to refocus on marketing and so forth, you guys had to do that, was because you were trying to put everything in a sandbox. Remember? So you know, that sandbox is only so big and it has, you know, only so many holes in it of a certain size, and sometimes that can actually be a detriment. We like to think, you open your mind a little bit and think a little bit larger. And then sometimes, you know, a seller's agent, a broker will you know, try to be very myopic. Sometimes a little too much so. Since we work with clients that do, and some do have seller's agents, some don't. You know, there's a money aspect to that as well from a financial perspective. But you know, the main thing is the agent in this particular case, we have a history with them of being very close with each other where we see valuation, where we see purchase price. Really, it's purchase price, right? And in the past history with those guys, you know, we've been off by maybe 3 or 4%, a few percentage points on what I thought a purchase price would be, and what they thought a purchase price would be. So that's was a good jumping off point in that particular transaction. And having talked to other companies, you kind of know what you like now. You kind of know what the market looks like now. It's not just what the market, but you know, hey, what do those frogs look like? You know, how do those other companies treat things? And so you learn through that process. And so some of the things we can do ourselves without a broker involved is walk you through that same process. And I know that you two can speak to that and, you know, what Cogent did for you guys in that regard, because we like to tell people that we work for both sides, even though our client pays us. You know, we're not cross purposes at all with the candidate company. You know, we're trying to get a transaction accomplished, and because we're buy side, we're still going to be there after the deal's done. We've been working with Aldridge now for what, 8 years, Patrick? Something like that? 8 years, I guess.
2010,
Huh?
2011. I think it's been 10 years.
There's so 10 years we've been working together, and we've helped him do almost all of those acquisitions. And you learn a lot along the way. So a lot, you know, most of the people in the company that came with those deals, you know, we still know them. They still know us. So brokers are kind of one and done. They kind of want to see the deal get done. But I agree that, you know, having an intermediary and having people that can help you, whether it's us or whether it's somebody else, is a great way to keep the edge off. We don't want, you know, both sides to be the antagonists in the movie and thinking that everything's going to be a fight, and the lawyers turn it into some sort of a fight, you know, document war. So we don't believe in that either. You know, we try to be fair and neutral and make things work. So, you know, our experience is hot and cold with brokers, but we do get stuff done, and we don't mind working with them. And we certainly want people to have professional advisors, whether it's us or somebody else, helping them through the process. That's for sure.
Patrick, I know that's a topic you and I have talked about, the benefit of having true professionals on the other end that's done this before, especially when it comes to the attorneys and that kind of thing. You want to talk a little bit about why that's important to us and maybe surprising to some?
Yeah,
Go ahead.
I think the surprising part is that, you know, I hear people talk and say, you know, I think we can really get a good deal here because they're not well advised or they're not represented well with a good attorney. And in my experience, the deals where there's not good representation on the seller side don't have a good attorney that does transaction work. Don't have a good CPA or tax advisor advising them on those things. You get far along and then you get off track so quickly for a couple of reasons. And what we end up doing as the buyer is our fees on the transaction, in terms of legal fees and our own advisors, goes up when the other side isn't well represented. Whether it's just an attorney that doesn't do very many transactions and then marks the document up like crazy, and then you have to go back through and explain everything and undo all the markup, over time in an otherwise
Can I
fair.
put it in a slightly different way? You can riff on this. We spent all this time building goodwill in the beginning, right? And then watching other advisors destroy that goodwill over silly things that really don't matter in the end. Creating a mountain, making a fire where there wasn't a fire. That's never any fun. We work our butts off to try to keep that from happening.
Yeah, I think that's right. And I think to Mitch's point, good advisors tell you what's really a big deal and what's not, right? And you could be chasing after a couple of sentences where the risk level is not real high. And if you've got a level of comfort there and you've got a good advisor that says, well, worst case scenario is X. Oh, I can live with X. That makes sense. And that's likely not going to happen. I think similarly, it advises you on what is market. So just, there are lots of things that both sides want in a transaction, but at the end of the day, the folks that know what's going on in the market, and Rick will attest to Cogent having to check me occasionally, I'll be like, oh, we should value it at this. He's like, is this 1999 again, Patrick? And I'm like, well, it looks good to me. He's like, yeah, it may look good to you, but you're not going to get a deal done like that. So to the point, good advice stops you from wasting a lot of time and energy.
Yeah, and that good advice doesn't always have to be, it's not always nice, and it's not always polite, and it's not always yes. A lot of times no, or let's do something different can be good advice. So there's a big part of that, and that's from both sides of the table. And yeah, just because you're my client doesn't mean I say yes to you every time, does it?
Nope, not my experience.
Yeah, Brian.
Anyway, go ahead.
Brian, if I could jump in here and kind of from the seller's perspective, I had not been through an acquisition before on either side of the table. And so, after we signed the LOI, we kind of got started into the due diligence process. I found that you having Cogent as your agent and helping through that process was just made it saved me a lot of money. It saved me, and on my advisor side because of the quality of the work that you guys put out there for us and the organized process we went through.
Thank you. Appreciate that.
Yeah.
We try to bring process to it. I mean, where an advisor can help, whether it's us or anybody else, is having process and being able to have a systematized process. You've done it before. You know how the movie ends. You're just trying to get from point A to point B. And we try to keep all the negotiation in front of the LOI, the letter of intent, or IOI, indication of interest, term sheet some people use. Some companies are very quick to put a term sheet on the table or put an IOI on the table and then do the due diligence afterwards. And a lot of times that's set up for disappointment. Somebody said, hey, our free cash flow is XYZ, and here's what our company looks like verbally. And then you do due diligence, and maybe that's not exactly true. And it could be pro or con, right? It could be either way. But you're having to what's called retrade that after the fact. Once people have signed up a piece of paper, we don't find that to be very productive, and it happens very often. What we try to do is a lot of our due diligence originally, prior to the LOI, which is one of the reasons we can have them focus on a good experience after the LOI, because we're just trying to get the deal papered up properly and done. We're not trying to get it negotiated. Does that make sense?
Yeah.
Yeah, so that's a sort of a difference between us and others, and just something to look for generally, whether you're working with us or not, is trying to get everything kind of worked out. So the idea of signing a letter of intent takes you through to closing on the same deal that you signed. So that's a goal.
On that note, got a question from the audience. What areas are covered in the LOI?
That
For us, go
certainly
ahead.
depends.
Go
I
ahead,
was going to
Patrick.
say it certainly depends on the
You go
buyer. I
first.
think what Rick and I are about to say the same thing, which is for us, we cover just about everything, right? Purchase price, deal structure, what assets are included, what assets are excluded. You know, our letters of intent are small font, multiple pages, as opposed to. But I've seen ones that are large font, half a page, right?
Yeah.
That are,
I got one of those.
a
Did
large
you?
font,
I
half
got
a
a half
page,
a page, large font, LOI.
and
All
then
right. What did you think of the difference between our LOI and that, just for giggles, on the same subject?
Well, in one respect, it was reassuring, right? Because it showed some thought went into it. On the other hand, you'll look at something, this 8-page letter of intent, and you say, they're trying to catch us on something, right? Wait, they're gonna try and zap us with something later on.
When's the other shoe gonna drop? And then it never drops, which is why we are still in business and doing well, actually. No, it's really interesting. So yeah, so you see, to just jump on that for a second. So the more you cover in the term sheet and the LOI in the letter of intent, which we like to use LOIs, it's a harbinger of what's also going to happen in the purchase agreement. And why not cover some of that now? Now, we can't go that deep and make the LOI a purchase agreement, so we try not to do that. We touch on and highlight all of the things that you're going to see later in the purchase agreement, so it's not a surprise. The worst thing for deals is surprises on either side, anybody, and no matter who it is. The seller who's now signed an LOI, so now they become a seller. The seller gets surprises they weren't understanding, or things they didn't understand. They go, oh my God, I didn't know that was true. Deferred revenue ownership is one of those subjects. We're not going to talk about that today, but that's just an idea of things that can go haywire. Some people don't understand that you're the custodian of the deposit money. It's not yours until you earn it. So they don't do deferred revenue right. And when they realize, oh my God, I spent that money already, the way I ran the company, it's not illegal or anything. There's nothing wrong with that, but it's not really your money. So when it comes time to sell the company, there's $100,000 worth of deposit money that you haven't serviced. Well, that's not your money. You got to give that to the buyer. A lot of people don't know that. And they see that as a surprise. If you don't cover that in the LOI, then it's a surprise. They go, oh my gosh. And I've had deals blow up over that. Actually, Patrick and I have had one that didn't happen over that. So it's just things like that, being thorough in a highlight way allows you to talk through things so that everybody understands. So when they see it next coming in the purchase agreement and all the due diligence and the schedules and exhibits that come with that, you've seen it before. It's been foreshadowed. Might be a good way to put that.
Yeah, you talked about having to retrade the deal post LOI. What's some of the things you've seen come up post LOI that was a surprise that you've got to go back and address, that maybe you didn't get right the first time, or it just didn't come up until you're doing due diligence? What's some examples there?
A recent one, actually, which we just worked through recently on a deal that's going to close hopefully in about a week. There was an SBA loan issue that was kind of new to everybody, lawyers on both sides, seller, buyer. The SBA just had this weird, quirky little thing that they had in a lease agreement relative to a property that had a loan on it. Without getting too deep, just this surprise thing we had to do that we kind of came up with the last minute. Could have been a deal breaker if the parties weren't so enamored with each other already. And it wasn't because we're close to closing. It's just because they all really trust each other and there's a lot of goodwill around the table. It's not been destroyed. So having this one little issue come, I was like, well, let's work it out this way. You happy with that? Fine, and done. But it could have been a problem, especially it was about no money had to change hands. So nothing had to change in the deal parameters. But what does sometimes happen is key customer issues are a big thing. Got a huge a large size key customer. Do you or don't you talk to them before closing? From a buyer's perspective, and how sticky is that going to be, and how touchy is that going to be? There's just lots of issues like that can come up. That does it make the buyer have pause? Ooh, gosh, I really need this, and is that going to be as some of our clients like say, is that a hill you want to die on, or is it something we can get over and work through? Is it something we can do immediately after closing? So there's always ways to negotiate around that. But from if something we have had clients go away, during sort of the last couple of weeks before closing, and there's enough of an economic impact where that can actually matter to the purchase price. And sometimes you have to reopen that up. But it's very rare for that to happen. Usually in due diligence, we're trying to do, prior to the LOI, we're doing discovery due diligence. And then post LOI, we're doing confirmatory due diligence. And during the confirmatory due diligence phase, if you find things that weren't exactly what you discovered originally, were they hidden from you on purpose or not, is a thing to think about. And usually, again, that's not the case, and things you can work through. Sometimes what happens, though, in deals that are more hastily put together that aren't as well researched, a retrade actually happens kind of on purpose, where the buyer kind of knows, hey, you told me your free cash flow was XYZ dollars, and they've seen the financial. They know it's probably not exactly accurate, so they make an offer based on everybody's wishes and desires, and they say yes to that, and then they get locked up under in the term sheet or the engagement agreement, and then when you do quality of earnings or you do the due diligence, you find out it's just not true, and it's just right there in black and white. It's not really an argument. It's not philosophical. It's just is what it is, and then it causes the buyer to say, I know we agreed on these terms and this price point, but I was just kidding. It's really this. And that we don't do that. It's philosophically we're against that. We would only retrade if we absolutely have to. If something really silly comes up, during due diligence, we just have to bring it up because it is what it is. Then that could happen. It's very rare. But there's people that kind of do that for a living too. And we think there's other places you can sell your company.
I'd say from our perspective, the most common thing that triggers a potential retrade has to do with staff and including owners, right? So you approach the deal on due diligence and it's, I'm retiring, my wife's retiring. You don't really need this guy. He's here because he's a family friend, and this guy's my uncle. And so those guys can all be out. Great. So you calculate the deal, we build the purchase price, we get down the road, we're ready to sign the documents. And they're like, oh, well, what about me? Where's my employment agreement? Oh, wait a minute. Well, you were an owner. We calculated you out.
Because you said you were out, by the way, not because
you were out, and
you said you were out.
And he said, well, what about my uncle? He's working hard. You're gonna have to replace him with somebody else. I'm like, wait a second. So the most common thing that causes us, to adjust purchase price valuation comes back down to staff every time. Or, oh, I forgot about that person, or it was vacant when you asked me for the census, and now we've rehired it. That's another common thing. And we've hired 2 or 3 people since we gave that information to you. Well, did your revenue go up? Well, a little bit, but we were investing in the future. And then so those staff things are the most common things that happen between LOI and deal closing that cause us to have to reevaluate.
Or even the day before closing in
right.
one instance.
Well, let me jump on that real quick. So on that same subject, what's really interesting is the guilt raise. Don't do that. Where it's getting close to closing and the owners are just feeling guilty that they're going to be, reaping reward that's not with their employees. And, we often say, hey, you can certainly set aside some money of your reward that you're getting from the transaction, for your employees. And that's wonderful to give an employee bonus and things. But sometimes what they'll do is just give everybody raises and do kind of stuff like that. It's like, ooh, that just changed the economics of the transaction. So I wouldn't recommend anybody doing that, or at least be talking about it. We've actually got another transaction we're working on where their ownership and the buyer both said, hey, we're coming around to about the same time of year, we got to give raises. So they talk about giving the raises. They're all on the same page with giving the raises. And then the buyer and the seller in lockstep. And it's just a common, ordinary course of business thing that you do. So that's okay, but you want to work together. You don't want, again, that surprise thing is always a problem, both ways.
Patrick, let's talk about the elephant in the room. Why on earth do 2 acquisitions at the same time?
Great question. And this is not our first rodeo, right? So this is
the second time.
But this time there was a little bit of space in between. At least there was 2 weeks. The last time we did it, it was the same day. And I would tell you, so there are 2 different reasons. If you look at the last time we did it, it was because the deal that we were buying knew somebody in town that they were thinking about a potential transaction together, and they said, well, maybe instead of one together and then looking down the road to sell it, maybe we'll just both merge into Aldridge. And that was also opening another office, and probably neither one on their own were big enough to open, a separate office. So that had its reasons for doing it. And then you've got the scenario that we're in right here, which is interesting because under normal circumstances, we wouldn't choose to do this. And if you listen to Chad's story, he and I first talked, nearly 2 years before we ended up doing the transaction. So in a perfect linear world, we would have had that conversation 6 to 9 months later. We would have closed the deal. We would have moved on to the next thing.
So
But
it's really Chad's fault is the moral of the story.
All Chad's fault. It really is.
that's what I'm setting up here. If you didn't get that, he told me no too many times. But no, I mean, it adds a bunch of pressure and a bunch of challenge to the team. But when an opportunity is available, if you don't act on it, this is a hot market right now. Everybody knows that. You just don't want to miss good opportunities. Plus, I mentioned before, sort of getting through those ceilings. One nice thing about these transactions, as close as they were and as hectic as it's been, we needed some additional management layers that I think with just adding one of the transactions, we would have gotten halfway there. But doing both gives us the size to be able to do both. And while the integration process will take longer, be a little bit more stressful, wear on us a little bit more, I think the end result will be superior to the other, to not doing it. But at the end of the day, if somebody said, should you do it or do you recommend it? The short answer is no, it's better if you can space them out. But unfortunately, life doesn't work linearly, and you've got to take opportunities when they're in front of you.
That happened to us just recently. I won't spend much time on it, but that just happened just really with a different client. Actually, this year, we closed 2 transactions within 30 days of each other, and so it does happen to other ones also, Patrick. But again, you've got to have to do that. You've got to have some help like us. If it's not us, somebody like us to be helping along, and also being able to have a good sort of interior integration crew, which Aldridge has developed over the years. With the staff that do one of their part-time jobs is to integrate a certain part of a transaction. And that's something that Aldridge has done over the years that we highly recommend other of our serial acquirer clients do. And again, it's because, and I want to touch on that, most of the transactions we ever do here at Cogent are talent acquisitions. It's a misnomer to think that people are just buying a book of business or just buying clients. That's not really what happens. It's very, very rare. Almost every transaction is a talent acquisition. So the biggest thing to be able to deal with, and I think it was wonderful that both of the people at both of these companies are experiencing good things after the deal's done, with all the talent being onboarded and so forth, and having new roles and having greater responsibility and having a bigger opportunity. That's wonderful news. I love hearing that also. But that's the way it should be, and that's because, again, focusing on the talent is such a big part of this. So as you do deals, whether you're the buyer or the seller, making sure that the team and that opportunity is manifest and it starts realizing itself is just a number one thing to deal with in any acquisition, whether you're doing them simultaneously or back to back or what.
You talked about pre-integration and integration mode, which we're in now. Patrick, talk just a little bit about what that looks like from our perspective and what a seller can expect up until close, and then kind of what it looks like after close and the process we go through.
Yeah, I mentioned that we've done a few of these. So, I think I've told both Mitch and Chad and just about anybody that I think we've possibly made every mistake you could possibly make sort of leading up into these deals. And so each time we recognize something that we either did wrong or that we didn't do well or that we didn't emphasize enough, we have a thorough lessons learned documentation process so that for the next time we can repeat that. So, leading up to closing date, there's a bunch of pre-integration. We're setting up the various pieces. We're making, we're moving other strategic goals aside, as Rick said, sort of becomes the part-time job of several of the folks here to make integration happen. So we start pre-integration on our end. We start moving strategic goals, making way and making room for this. And then, we don't generally talk to the seller's staff and involve them in the discussions until 1 or 2 weeks prior to the transaction in a perfect world. Sometimes not until the very day. It's a whole nother topic. But, so we start getting everybody involved. We have some internal folks that we sort of make way for. We have external consultant that helps us operate, run that. We have other consultants like C-level operations that, they start to gear what they're focusing on for us toward the integration of these teams. So, there's a bunch of shifts of priority that happen, in the 2-3 months leading up to transaction. And then we dive into what has become an 1,100 item project plan for integration that covers everything from back office, make sure we're paying the rent, we're doing the client billing, to technology platforms. We got to get off of 2 PSAs onto 1 PSA, 2 RMMs to 1 RMM. And, and so we have this whole evaluation process. This who's are we keeping, the buyers and sellers. And, it ends up being a reasonably fair split in terms of backup vendors and, firewall. There's just so much to put together. And so we sort of step through this plan. And anytime we feel like we've made mistakes, and you'll find on both of these deals that there are at least 10 items under lessons learned, things we could do better next time. Nothing catastrophic happening, but it doesn't have to be catastrophic to make the list. It just has to be something we want to do better or emphasize more. And we just sort of step through it over the course of, we're probably pretty active on that sheet between 6 and 9 months. And then it gets into straggling mode, right? And then we just have to clean up some stragglers along the way. Brand marketing is in there. There's so many things to consider. And so we've built this over time, and we get together for 3 hours every Wednesday as a big team to step line by line. Did you do this? If not, when are you going to do it? By when? And it's been a pretty successful process, throughout time.
I'd like to hear from Chad and Mitch on that. I'd like to hear Chad and Mitch comment on that, both sides.
Well, I'll go ahead. I mentioned in the post LOI, and I've told many people. I said, you don't, as much as you do your due diligence and kind of try to figure out what this is going to look like, you don't really know what it's like until you're in it. And my experience between LOI and closing, and even since closing, is that the organization and the process that's been put forward has made it fairly straightforward. And we know what's coming, we know when it's coming, we know what needs to be done now and what can wait. And it's, it's been in having the outside help, I think, and the experience that Aldridge has had in this arena has been great. My customer's experience has not changed at all, and that's been our goal, is to smoothly transition this with only improving the customer experience, and I think we're on track to do that.
Mitch, what do you say to that? Sorry for moderating there, Brian.
You go right ahead.
Gives him time to read questions. Right? So Patrick said that we've made lots of mistakes and we think we've learned from them. I was at a conference last week and I saw a woman wearing a T-shirt that said, "I've learned so much from my mistakes. I'm planning to make a few more." And I think that's where we are, right? And I think that I would caveat Patrick's answer about, we've got this great 1,100 item checklist, and I caveat it this way: the company Aldridge was 5 years ago, the last time they learned some lessons, is not the company they are today, right? And so a lesson you think you learned might actually be the wrong lesson for now, right? Or something, you need to do something different, right? So I like to say that we all have, every human being has this thing called a positivity bias, right? We think everything's going to be fine and we think everything's going to be better than it actually will be, right? So it is hard, and you are constantly learning new things. And like the T-shirt said, I'm planning to make a few more mistakes because I've learned so much from the ones in the past.
That's awesome.
If you're not making mistakes, you're not trying.
Yeah.
That's exactly right. I agree with that. I
To
agree
Patrick's
with that.
point that we do a standing 3-hour long Wednesday meeting working through the integration. And we start out by, is there any impact to clients, any impact to staff, and what are the lessons learned before we get into anything else? Because I feel like we've added something to the lessons learned every single week, whether it's we missed this step and we need to make sure we get it next time, or we could have saved ourselves some hours worth of time if we approach it differently. We're getting a few questions about the client's perspective during the integration. Patrick, you want to talk a little bit from our perspective on what the messaging is to clients and what clients have seen so far versus what they're going to see?
Yeah, I can tell you what we preach, and then maybe Chad and Mitch can talk about what it's like from their client's perspective. But the number one rule, and I think everybody that's involved in this acquisition is probably tired of hearing me say, the number one rule is don't wreck anything. So in this case, we're running 3 businesses, and we have the priority to make those one business. But that's the second priority. The first priority is don't wreck anything. So our objective is don't change anything from a client experience unless we absolutely have to, or unless we're improving it. And legitimately improving it, not just thinking our way is better and pushing that down to the clients. One of the things we have to continue to remember is the client didn't choose us. They chose the predecessor company, and they liked the way they work, or they wouldn't have been with them for 7 or 10 years, right? So how do we bring those things forward, but still be part of a larger organization that has more bench depth, that has more capability? The answer is, do all the back end stuff first, and then make those process improvements along the way, but get the feedback from the sellers and the sellers staff, the sellers management team, all along the way, saying, is this important? Is this important? Do your clients care about this? Because it's also easy to spend 20 hours of work by 3 people on something that, like, oh, our clients don't care about that. Don't bother. And you're like, oh, just because the project plan said do it doesn't mean we do it. It means we check in and say, hey, is this really what we need to do? So we're operating under the don't wreck it plan, and work toward getting all, in this case, we sort of gave ourselves 11 months to be operating fully integrated and on a predictable, profitable trajectory after we get to 11 months, with minimal client loss. And so far, so good from our perspective. I'm interested, to hear, Chad, what you think, or Mitch, about what your clients have seen so far.
Yeah, I think, one of the things that, as I've communicated to our clients along the way, from my very first conversation to them, that this transaction had happened, and giving some of my reasons why have we done this, and one was that there are more resources going to be available to clients, and we didn't have a 24/7 knock, and that was something that we're bringing to the table now. And so I think there's, it was pretty easy for me to communicate to customers that the long term here is positive. Now, they've been very understanding that, well, all of that's not immediately available to us to, day one. It's going to take us some time to integrate together. I think if anything, their misperception is that when anything at all happens, they think we've already done something and didn't tell them, and we go, well, no, we're just doing it like we always did. We may have misstepped in this instance, and so we'll get to but we're going to tell you everything we're going to do ahead of time. And so I've found customers to be very understanding, and in many occasions very excited about what's happening.
Mitch, how about you?
Yeah, I would echo some of what Chad said, that I think communication is so important, and we put a lot of effort and energy into communicating to clients, and also, as Patrick said, trying to not do anything that would affect them. But I would say that there's two exceptions to that. One is once you announce the deal, anything bad that happens is Patrick's fault. Right? I knew this was going to cause a problem. You guys, this merger, it messed everything up, and you can talk till you're blue in the face saying, no, that was one of my regular guys who's been taking care of you for years, screwed up. No, everything that happens is the new owner's fault. right? So you get blamed for everything. The other thing I would say is I think that it depends to some degree also on some of the stuff that it's just barely starting, right? Here in San Antonio, we have a steeper hill to climb in sense of changing tool sets and changing culture. Things are being more different for us and our people than they are for Chad and Chad's people. So I wouldn't say anything terrible has happened. I would just say I think the jury's still out a little bit because we've just started climbing just this month, some of that steeper hill. And so there's some dangers ahead that we don't know whether we're going to avoid those potholes or not.
I have a question when you're done.
I'm done.
So for you guys, when you talk about the clients, I mean, I want to make a point to the audience that you don't announce the deal until you've talked to at least the key candidates and so forth. And at Cogent, we have the ABC plan, and I think that's probably ingrained with you guys a little bit. The A's get as much attention as needed. The B's, you get a letter and a nice phone call. The C's, they get a letter, but sounds trite, but it's not meant to be trite. But so talk a little bit about that. So you're not putting out a press release and hey, we just did this, and the clients go, what the heck? Because that's the bad
the
way
press
to do
release
it.
comes out after everyone's already been talked to.
Oh yeah.
Boom. Okay. I just want, talk about that for 5 seconds, just because I think that's really important for people to understand.
Yeah, that's one of the things that we guide through in the pre-integration process is gear up. When we close the deal, who are the clients you need to call? Who are the clients you want to face-to-face? COVID made that a little weird, a lot more video, which is kind of nice in some ways. But yeah, so have those conversations first, then you get the letter. Then the press release is probably 2 weeks trailing that. Give everybody time just to absorb it, see what's going on before we tell the world what's going on. Which it's got some pluses and minuses. The downside is we don't even begin to integrate vendor stuff because we're afraid a vendor might mention, a back-end vendor might mention to a client, or might find a new name there. We want to make sure everybody understands why we did it, what we're doing before we really do any of the heavy lifting.
Mm-hmm. I just wanted to sort of reinforce that point with the audience.
Yeah, I think it's good. Got a lot of questions still, but a lot of them are around valuations and the state of the market. A couple of points. We'll make sure in the follow-up email we'll send a link to the previous session that we did where we really dove in on some valuation models and that kind of thing. But Rick, why don't you just kind of give us a general update on what's going on in the market right now?
So it is a pretty red hot, on fire sellers market right now. There are a lot of buyers. There are many, many, many companies that want to be buyers. Private equity, yeah, right. Private equity companies, operating companies of every size, smaller companies, huge companies. We're as busy as we have ever been. Again, we're trying to close deal 8 and 9 for the year this next week, with more in the pipeline and people in LOI and so forth and so on. So we are trying to do the right thing for all our clientele. Our clientele has grown also. We're pretty selective about that, but the clientele has grown. And what that means is it's not, so everybody likes to talk about multiples. Everybody likes to talk about valuation. We've been beating this to death, and you can look on our website and look at things we've done and webinars we're doing as well, and things we've done with Patrick and his team. It's not really valuation, it's a purchase price. So the purchase price has gone up a bit, but it's really based on your intrinsic value. It's still free cash flow based, and it always will be, and it always has been. It's not about, yes, it's nice if you do more MRR than not because it's a risk factor thing. So without getting too deep into that, the market right now is fervent. I think it's going to be that way for a while. I think some of the tax language that's been bandied about in Congress and so forth and in the media has fanned that flame a little bit for some people worried that they need to take money off the table now, or it's going to cost them more later to take that money off the table later. The jury's still out on that. That's not been made into law yet. Although there's people concerned about that, so that's adding a little froth to the market right now. People thinking they might miss the boat. And then I don't think that's going to really change the market next year, the year after that, because the IT service industry is so essential industry. COVID, the pandemic, proved unabashedly that IT services are an essential industry in the entire world, and for that reason, most IT companies do very well from a percentage of earnings against top line. Forgetting the word EBITDA for a minute because it's a bit of a misnomer. Free cash flow is really what it's all about, and you can make IT businesses make good money and reliable money, and MRR is more reliable and more risk averse. And who doesn't want to invest in that type of business? So I think that's going to go on for a long, long time. It certainly is going to be good for Cogent. I think it's good for everybody in the IT space. It's really, again, finding the right dance partners, being able to take advantage of scale, being able to take some of the things you heard today, being able to have a more robust service suite, have more people that can service your customers. You've got more resources for those customers to take advantage of. That's a great reason to do a deal. There's a lot of really good reasons to put companies together. I think a part of it's your own personal economic reasons. But right now, and I think for the foreseeable future, we see this being a seller's market for quite a while.
Very good. Well, thank you all for joining us. Thank you, attendees, for being here again. Like I said, we're going to be sending out a survey after this. Please take just a few minutes, give us some feedback, let us know what else you want to hear about. We'll check back in a few months about integration and give an update on how things are going and talk in a little more detail on post-close integration. So keep an eye out for that. But yes, thank you all very much and have a good day.
Thanks.
Bye, everybody.